Okay, yeah. So today we are going to do 2024 big HRM 120 financial accounting paper. So we are going to start with question 1. So here is the question. We've been given a short trial balance and a lot of adjustments down here, as you can see. So the question is requiring us to prepare the statement of financial position as well as the statement of profit and loss account for the year 2015. Okay, so I've already drawn the nice lines so much that it's going to be easy for us. Okay, so first thing first, we're going to write the heading. So the name of this company, this is Tancard company, I think Tancard. Okay, so this is Tancard company, profit and loss account. For the year ended or ending 30th June 2015. So this one is prepared in, this one was prepared in dollars, not in kwachas. This is dollars. Then we have our details column here. So first thing first, we're going to start with our revenue, which is sales. So our revenue according to the question was sales revenue was 487.42. 487.42. But then on the third adjustment, the question is saying during the year an item of plant and machinery was disposed of for 5,500. This plant and equipment had cost $12,500 and had the carrying value of $6,250 at the disposal date. The cash receipts has been wrongly included within the sales revenue. So within the sales revenue, which had the figure of 487.42, is wrongly containing $5,500. This was sale of plant and machinery which sold. Now they indicated the amount of this in the sales account. Remember, the sales account will record only things that we sell. Let me say stock. Every time we sell stock, we record it as sales. But if we sell an asset, that is not, we don't indicate it in the sales revenue because that is an asset. It has a separate account. So this amount was indicated in the sales account. So we're going to remove the $5,500. So this is going to be 475,242. So that was supposed to be our revenue figure. It was only 487.42 because they entered the wrong amount in the sales revenue. So that is the first part. Next part, we're going to do our cost of sales. Under cost of sales, the first thing to appear is our opening stock, opening inventory. So our opening stock, according to the question, inventory was 84,220. 84,220. And the purchases which goes in the mid column is the net purchases. Any adjustment that's supposed to be made should be made in the first column so that the net purchases figure will be transferred in the mid column. And in our case, our purchases was 153,444. Okay, 153,404, which is here. And I think we don't have any adjustment on purchases, so the figure is going to go direct in the last column. That is 153,444. Okay, so we have 84,220 plus 153,444. This is giving us 237,664 dollars. Okay, and then we're going to less our closing stock. But closing stock also has an adjustment. The first adjustment is talking about closing stock. So it is saying inventory at 30 June 2015 was valued at cost of $94,302. Now included within this were several items of inventory which cost $5,000, but it was estimated that they could only be sold for $4,000. So the sales, the stock itself is assumed to be $94,302. Now they are saying within this there's 5,000 stock items which are worth $5,000, which now could only be sold for $4,000. So in our stock there are some items which have already lost value, maybe because of damage and stuff. Maybe the goods are damaged. So the goods which are worth 5,000, the goods that are worth 5,000 can only be sold for 4,000. So those goods are already damaged, which means they cannot be sold at the value they were. They are supposed to be sold at a lower value. So which means these items were costing 5,000, but they're saying they can only be sold for 4,000. So which means they have lost value of 1,000. So from the stock, we're going to remove that 1,000. So the stock itself was 94,302. We're going to remove the 1,000, meaning our closing stock is going to be 9,302. Okay, so since closing stock is subtracted from our cost of goods available for sale, so we are going to remove it from the cost of goods available for sale, which is 237,664. So this is going to give us 144,362. Okay, as our cost of sales figure. So that is our cost of sales. So it's a negative because I was subtracting from a smaller number. Let me say I had put the 237 first, then I'd put the 93,302 first, then minus that one. That's why it is appearing as a negative. Otherwise it is like this: 237,664 minus 93,302. So that's the figure which is there. Now, because we know that cost of sales is subtracted from the net sales, so we're going to remove it from net sales. So net sales, I'm writing net sales last, which means since it's the biggest figure, we are going to have a negative as well. But the figure itself is not supposed to be a negative. It's only because we started with a smaller number. So that is our gross profit. That is our gross profit. So I said we have to check on the allowance for receivables. So in our case, our allowance for receivables was 550, but according to adjustment 5, it is saying trade receivables include an amount of 631, which is regarded as a recoverable debt. Let's not talk about that one first, and it is to be written off. In addition, the allowance for receivables is to be adjusted to 393. So I said if the allowance for receivables, remember the allowance for receivables is given in the trial balance, and allowance for receivables is given under the adjustment. So if it is increasing, that increase, that difference is going to be an expense. But if it is decreasing, that decrease is going to be a gain, and gains are the ones which are added to the gross profit. So in this case, it was in the income statement, allowance for receivables was 550, but it is being reduced to 393. So which means this one is a reduction in the allowance for receivables. Last year, you were assuming that 550 people were owing you money, which you think you may not be able to pay back on time. But this year, the number has reduced, which means the business is doing well. The people have paid. So that is a gain to the business, because that amount you've already assumed that these people will not be able to pay me anytime soon. So if they pay, that is good for the business and it's a gain to the business. Okay, so no wonder a decrease in allowance for receivables are supposed to be added to the gross profit. So since we're adding incomes for gains, the first thing that we're going to add in this case is our decrease in allowance for receivables. For receivables or bad debts. Sorry that my line has exceeded the normal line. Okay, so it was 157. The increase just, sorry, 157. Write it from here. Okay, so in the income statement it was 550, in the adjustment it is 393. So we're just concerned about what is the difference. So the difference is 157, which we're adding to the 338.18. Okay, so this is going to give us 331,037. This is because we don't have any gains. The gains I'm talking about mean anything, any item that has received at the end, not receivable but received, things like discount received, rent received, if it's there, then also commission received, interest received, if it was there as well, it was supposed to be added to the gains. Okay, so next we're going to list our expenses. Under expenses, the first expense that we may forget is our irrecoverable debts or bad debts. They said during the year adjustment 5, trade receivables include an amount of 631, which is regarded as irrecoverable debts. That is 631. So we should not forget about that one first. So from the trade receivables figure, they are saying this 631 is a bad debt. People that are owing us $631 will not be able to pay. Maybe they have died or some other reasons, they'll not be able to pay. So that is a bad debt. We should remove it from the debtors that we're having. So we'll do that in the statement of financial position. Okay, so our bad debts are 631, and also next we have okay, we have an interest here on the loan, but we'll talk about that one later. Then we have our administrative expense. Administrative expense, the figure here is 37,666. 37,666. I'm writing from the first column because there's an adjustment. So the adjustment on administrative expense, there is this adjustment which is adjustment 7. It is saying include within administrative expense is an amount of 3,000 for insurance. This payment covers the 15-month period to 30 September 2015. We're preparing this in June, but they're saying this amount covers the 15-month period to 30 September 2015. So which simply means this is a prepayment. We're preparing this in June, not in September. So this is a prepayment, and the prepayments are subtracted from the income statement. So we are going to list the administrative expense prepaid. Okay, I don't have enough space. Prepaid, which is a 3,000. So it was a 37,666 minus 3,000. This is giving us 34,666. Okay, next, from administrative expense we have distribution expenses. Under distribution expenses, the amount there is 23,587. 23,587. I'm writing from the first column because there's an adjustment as well. So the adjustment is explained on adjustment 8, in which they're saying an accrual should be made for unpaid distribution cost of 3. So because it's an accruals are added in the income statement, so there's an accrual of distribution expense, which is $3,245. So we have a 23,587 plus 3245. This is 26,832. 26,832. Okay, next we'll have to consider this statement here. They're saying the third adjustment, during the year an item of plant and machinery was disposed of. So this item was sold for $5,500. This plant had cost $12,500 and a carrying value of $6,250. Okay, the cost was $12,500. And then it lost value. In order for it to reach the net book value or the carrying value, it had to depreciate. So it depreciated. So we're going to get the cost minus the net book value, which is $6,250, which means the item was worthy $6,250. But what did they do? They had sold it at $5,500. So we're going to that is the normal amount that's supposed to sell this item, because it was $12.50. For it to reach at $6,250, it had to lose value of $6,250, which is the depreciation. We'll talk about that one later. But in our case now, this item was sold for $5,500, which means they've made the loss of $750. So we have to consider that loss on item disposed. which is a 750. A loss is an expense. If it was a profit, it was supposed to be added to the income stroke gains, but in this case there's a loss. Okay, so next, we don't have any other expenses apart from the interest. Okay, yeah, we have depreciations. So we're going to start with the depreciation of buildings. Depreciation of buildings. Okay, so buildings, the statement is here. They're saying building is charged to the cost of sales for the year ended 31st 20. Okay, then they're saying building 2% per annum on straight line basis. Okay, now let's not forget adjustment. Okay, on adjustment 2, adjustment 2 is saying included within land and building is non-depreciable land as a cost of 80,000. Remember, land doesn't depreciate, which means in the figure for buildings and land, there's 80,000 for land which doesn't depreciate. So we're going to remove the 80,000. So the figure for building and land and buildings at cost, it was 281. Land and buildings at cost was 281 450. We're going to remove the 80,000 which is for land, because land doesn't depreciate. What we do with the depreciation, we should remove land. Okay, so if we remove land, we're going to remain with that amount as our buildings. So 2% of that, so we're going to multiply by 2, divide by 100. So depreciation of buildings is 4029. We have removed the 80,000 because it is non-depreciable. Land does not depreciate. So that is the depreciation of buildings. Next, depreciation of plant and machinery. Okay, so depreciation of the plant and machine, this one they're saying 25%, so 25 divided by 100 times plant and machinery at cost was 94,400. So this is 23,600. This is 23,600. Okay, so we are done with the expenses. Okay, so the first expense is 631 plus over 631, which I've already added, plus 34,666 plus 26,832 plus 750 plus 4029 plus 23,600. This is giving us a 9508 dollars, which is our net expenses. Net expenses. So when we remove it from the gross profit, which was 331037, we have 245.29 as our net profit before interest and tax. So this is our net profit before interest and tax. Okay, I can still do that. Okay, so we're going to less our interest. So on interest, we have this loan that was acquired. This company had to acquire a loan of 26,000. Now they're saying there's a 7%. So that 7% is the interest which we're talking about here. We're not talking about the loan itself, but we're talking about the interest on the loan. So 7% is 7 over 100 times the 26,000. So this is 1820. So we're going to remove the interest of 1820. So 1820, it was, remember, it was 240 529 minus 1820. We have 238,709 as our net profit before tax. Net profit before tax. Okay, then we are going to less our tax. Our tax is given. So our income tax is given in the last adjustment as is estimated to be 31,830. So from that figure, we're going to less our tax of 31,830. Okay, so from that figure, we're going to remove our 31,830. This is a 206,879. This is 206,879 as our profit for the year. And we're going to add our retained earning, which is the profit for the previous year. So we're going to add our retained earning. From this amount, we're going to add our retained earning, which was profit for the previous year, and our retained earnings on 1st July 2014 were 11,467. 11,467. So plus this amount, we're adding 11,467. This is 218,346. 218,346 as our profit. We are done. This marks the end of the income statement. Next, we are going to the statement of financial position. So I'm going to pause so much that I'll be able to draw lines on the other side quickly so that I'll be able to move on time. Okay, so yeah, I've already drawn the lines for the statement of financial position so that we're going to move on the first rate. So we're going to start with the land itself, which was removed. Remember, it was 80,000, and since land doesn't have to depreciate, it's going to have a zero there, and the final amount is going to be 80,000. Then coming down on buildings, we said buildings, land and buildings themselves were 281,450 minus 8,000 for buildings. For land, so for buildings, it's going to remain with 201,450, and the depreciation, we said 2% of that, so it was 4029 plus the accumulated depreciation, and the accumulated depreciation of land in buildings, accumulated depreciation is 63,332. 65332. Okay, so this is giving us 69361. 69361. When you subtract it from the 201, this amount, you subtract from this amount 201,450, we have a 132,089. 132,089 here. That was for buildings. Then on plant and machinery, we should not forget that there were some plant and machinery items which were sold. Okay, so the plant and machinery, the cost was plant and machinery, the cost was 94,400. Okay, but let's not forget that there are some items which had costing 12,550 and which had a carrying value of 6,250. So these items were sold. So we should not forget this statement. So these were plant and machinery as well. So which means in this amount, there's already some items which were sold during the year. So we're going to remove that because those items were removed. Remember, these balances are there on 30th June 2015. So which means within this amount, just like what happened to buildings and land, buildings doesn't depreciate and we remove the amount. And this from this same plant and machinery, we have some plant and machinery which are being sold. So we are going to remove that as well. So we're going to remove the items. So the items were, they're saying these plant and equipment that had cost 1250 and had a carrying value. So at the time they were sold, their value was 6,250. So we're going to remove the 6,250 from the plant and machinery because at that time they were selling them, this was the value, 6,250, value of the items, and they sold them. Yes, of course they sold them on a loss because they were supposed to sell them at this amount, but what they did was they sold them at 5,500. That's why there was that loss of 750. But here now we're interested in what was the amount of the plant and machinery which was sold. So which means the items now that are going to remain from the plant and machinery are 88,150. Okay, then the depreciation that we calculated was 23,600. The depreciation of land and plant and machinery was 23,600 plus the accumulated depreciation. The accumulated depreciation of plant and machinery was 24,500. plant and machinery accumulated depreciation was 24,500 to also plus 24,500. So the depreciation there is going to be 4,800. And remember, this minus this, we're going to subtract it from 88,150. Sorry, 88,150. This is going to give us a 4 like that. Okay, so we are done with our non-current assets. Sorry, I didn't indicate the heading here. These are non-current asset or fixed asset. Okay, so we are done with the first part. We're going to add this here, add this here, add this here, but remember these are not important, so as at now I'm going to skip them because we're not going to use them anywhere. So I'm just going to add what is important. So we have this amount which is already there plus 132,089 plus 80,000. So this is 252,139, 252,139. Okay, I was using a negative because I had already a negative figure here, because I started this minus this, which gave me this one, which is a negative figure, minus this one because I'm going to the same direction. Otherwise, if you add, you are still going to get the same figure there. So that is it. That's all for our non-current assets. Then next we're going to the current assets. Current assets, we have our stock, and the stock itself, just like we said, stock which goes in the statement of financial position is our closing stock, and our closing stock was 93,302. We're removing the 1,000, it was 94,302. Now we're removing the 1,000 of the goods which were destroyed, so it is 93,302. Then debtors, or what we call receivables. Debtors were trade receivables were 13,731. 13,731. Now let's not forget there was some this the third adjustment. No, sorry. Let's not forget fifth adjustment, which they're saying trade receivables include an amount of 631, which is regarded as bad debt. So we're going to remove that bad debt. Bad debts, which is where the 631. So since we're subtracting, I'm going to put that in bracket. And also remember, it is always debtors less provision for doubtful debt. So we're going to less provision or allowance for receivables, which was the allowance for receivables was 393. The new provision is the one that goes in the statement of financial position. The other one is just used to compare in order to get the difference. So we're going to subtract as well 393 from our receivables. So it was 137.31 minus 631 minus 393. This is 12,707. And also we should not forget that prepayments are also part of current assets. So there was that insurance prepaid, which was in the administrative expenses. So there is that insurance prepaid, which was 3,000. This one here, the seventh adjustment. Okay, then when we add this, we don't have any current asset. So we have a 12,707, which is already on the calculator, plus a 3,000 plus 93,302. This is giving us 109,009 as our total current assets. When you add our total current assets plus non-current assets, which was a 139, we have 361,148 as our net assets. Net assets. Okay, so we're done with the first part. The other part, financed by equity has components in this case. So we have the share premium, we have share premium. Our share premium was 12,500. We have ordinary share or stated capital. ordinary share or equity shares, which is 40,000. 40,000. And then we have our income surplus or the net profit, which is coming from the income statement. So we have the net profit, or what we call income surplus, which was 218,346. 218,346. Okay, so if you add this, we have 125,000 plus 40,000 plus 21,8,346. Okay, so this is 270,846. 270,846. Okay, this one is not clear. Then next we go to the current liabilities. Current liabilities, where we start with our creditors and other payables. And other payables, which is trade and other payables, 25,342. 25,342. Okay, then let's not forget there's this accruals on the credit side, so let's not forget the accruals there. 1217. Okay, then there's this cash and cash equivalent, which is on the credit side, which means that is an overdraft because it's on the credit side. If it was on the debit side, you're supposed to be cash, which is either at hand or in the bank. So there's this cash stroke cash equivalent, cash equivalent, which is 848. Okay, 848. Then let's not forget there was a distribution cost which was accrued. This one, the adjustment 8, an accrual should be made for unpaid distribution costs. So that is an accrual or distribution cost owing. Still means the same thing. So there is a distribution cost owing, okay, which is worthy 3,245. Okay, then let's not forget interest and tax. So tax was 31,830 and interest was 1820. Okay, so we have 25,342 plus 1217 plus 848 plus 3245 plus 31,830 plus 1820. Okay, so this is 64,302. 64,302. Then let's not forget long-term loan, which is the loan itself, which was worthy, the loan was worthy 26,000. Okay, so this one is going to give us over 26,000 plus 64,302. It's giving us 93,002 plus the 270,846, which is on top, which is giving us 361,148 as our equity stroke liabilities. So that marks the end of the first question. Next, we're going to do the other question in the next video, which is, what question is this? Question 2. So I'm going to pause the video so much that I'll prepare the lines already in advance so that we are going to be very fast. Okay,